Just how much is South Africa's credit regulatory regime to blame for the collapse of African Bank? And how much is it to blame also for the fact that many South Africans are highly indebted? This is Tonight. I'm Bruce Whitfield. Tonight I'm joined by Ian Wason, Chief Executive of Debtbusters. He's in our Cape Town studio. And Neil Roets, the Chief Executive of Debt Rescue, to find out whose fault the current mess is. Let's go to you first, Neil Roets in Johannesburg. Why are South Africans so massively indebted?
Well, Bruce, it's difficult to say why they are over-indebted. The bottom line is just that consumers are over-indebted. And if you look at the stats provided by the National Credit Regulator, almost half of all credit-active consumers are over-indebted. Now, what can contribute to that, obviously, is all the price hikes that we've seen in the past couple of months. With petrol prices going up and the interest rates going up. Now, if you look at petrol prices, for instance, if those prices go up, it doesn't just affect consumers when they put petrol in their car. The prices of all other goods and services also go up in line with it. And when petrol prices go down again, you don't see other prices going down. So I think, if you look at the unsecured market as well, with certain banks struggling now, that's just indicative of how consumers are struggling out there.
Okay, so in West, would you agree with that? It's almost as if we're giving the credit providers a little bit of a free ride based on that explanation.
Yeah, I think the reason why South African consumers find themselves in this situation where, as Neil pointed out, 10 million of them are more than 3 months in arrears on their debt, is a combination of factors. You have a first world banking system in South Africa and maybe a third world financial education in the population. I think a lot of credit providers have over-pushed credit. We all know about the SMSs we get on our phones and the letters pushed under our doorstep saying, take a 10,000 Rand loan, call us today, etc. And I don't think the general population has been educated enough at school or at work about the dangers of credit and the perils of credit. So that's kind of what's got us into this mess in the first place. Obviously, for the large banks, the slowdown in mortgage lending and the flattening of property prices in 2008 has made them look for more profitable lines of products of business, of which unsecured lending has been one of them. They could see how much money African Bank was making back in the day, and they decided to get a piece of it with shareholder pressure probably to go after that.
Absolutely. All of those reasons are completely clear, but the National Credit Act was supposed to protect consumers from themselves. We saw the huge boom in credit, secured credit, during the first decade of this century. We saw it came through in the mortgage market, it came through in credit cards, it came through in vehicle sales. All of these things were deemed to be secured credit. Then the bottom fell out of that market. Whose bright idea was it to go hell for leather into the unsecured market, which the banks wouldn't touch with a barge pole during the good times?
Whose bright idea? Well, look, it's capitalism. There were big margins to be made, far greater margins in unsecured lending than there was in secured lending. They were trying to then get market share from the traditional unsecured lenders like African Bank, and it caused this sort of race for market share. We've seen unsecured debt, so generally personal loans, grow from about 30 billion Rand 4 or 5 years ago to 172 billion Rand. The credit providers in South Africa lend far more money now on unsecured debt than they do on residential mortgages.
So where did the
so
National
if you're a believer
Credit
in
Act
good debt and bad debt,
yeah. Where did the National Credit Act come in? Where did it go wrong, Neil? Because National Credit Act comes in response to this boom in secured credit.
Definitely, and I do think that the National Credit Act did help us, especially back in 2008. With the recession, I think we would have been worse off without the National Credit Act. But like with any new act, there are grey areas. And I think most of those grey areas were now addressed by the amendments to the Act. And
but those amendments aren't yet through, are they?
No, they're not yet through. But obviously we can look at the proposed amendments, and it looks very good. And
but it's taken 5 or 6 years to get to a point to say, oh, it's not working, during which time We've seen unsecured credit go from 30 billion to nearly 170 billion rand. Where were the loopholes, and who's guilty of exploiting those loopholes?
Definitely, you're right, but you must remember that another issue that might have, or factor that might have contributed to this is reckless lending, the issue of reckless lending. Now, the banks obviously were more vigilant in giving out home loans and vehicle finance, for instance, after the implementation of the National Credit Act. So that's why, like Ian said earlier, they started concentrating on unsecured debt. But, these are all issues that were raised in the past couple of years, let's say the past 5 years, and they are now addressed in the amendments of the Act. So, yes, obviously it did take a long time. But I think that was also necessary to identify the issues and to address them properly now in the Act. And I really think that the amendment to the Act is going to make a very big difference.
But isn't the damage done? And that's the real issue. I mean, for years we've had average debt to disposable income levels in South Africa of something like 75 to 80%. I mean, huge by global standards. Yet banks have continued lending into this bubble.
Yeah, the damage, in my opinion, has already been done. The horse is already bolted, the debt is already out there, and now we've got to clean it up. But just while you're talking on the debt-to-income ratio, actually 76, 77% is relatively small compared to international standards. In the UK, it's around 135%. Now, if you take our clients, as in Debtbusters clients, their debt-to-income ratio on average is about 134%, so less than the UK population average. So it's not a question of how much debt the consumers have got, it's what sort of debt they've got. So in the UK, the vast majority is on mortgages, and mortgages in the UK can be as low as 1% at the moment. And of course, mortgages are over a long period of time. The problem here is the sheer unaffordability of the debt. It's the short-term nature and the expensive nature of the debt. You can charge interest rates of up to 60% for short-term loans. And remember, it's not just the interest rates, you've got the monthly fees on there as well, and the horrific expense of credit life insurance. And some credit providers are charging up to 40 Rand per thousand. And just before you jump on that, there is a huge difference in credit providers. So
sure.
Let's look at the big four banks have a very good affordability mechanism, affordability test before they lend money. But as you go down the scale in banks to maybe the smaller credit providers, they have very little affordability tests, if any. I mean, I know some small credit providers who haven't traditionally even done credit checks, let alone done income and expenses analysis, done a full credit check to see what other debts they've got. And that is really what's caused the problem for the big four banks, because it doesn't matter how well they've been lending, it's who comes after them. And our average client has 11 different credit agreements.
Is there a book, any book, worthwhile throwing at somebody who we can finger and say, this is largely your fault? Here was the rule book, you chose to ignore the rule book, you sought the loopholes in the rule book, and you pursued credit for your own benefit, regardless of the longer-term consequences on South Africa as a society.
Regulations anywhere in the world are always too slow. Obviously, the private sector always finds a way around regulations and new acts like the National Credit Act, and they found a way around it with the National Credit Act when it was introduced in 2007, and that gap was largely the lack of a defined affordability test. So that, for me, is the biggest problem.
Yeah.
Should something have been done earlier? Should amendments to those acts come in? Should the regulator or the DTI put in that affordability test and criteria? Yes, they should have done. They're doing it now. Is it too late? Well, yes, it is, but it's still going to help. But if they'd done it 4 years ago, we probably still would have a problem, but it would be nowhere near as big as this. And African Bank may still be around in the form that it was a month ago.
Neil Roets, who do we blame? Do we blame the Minister of Trade and Industry?
Well, that's difficult to say.
Come on, make a commitment, man. Put a line in the sand.
A couple of people are to blame, I suppose. But
who would you like to blame?
No, the thing is, you must also look at the consumers themselves. There's something like reckless lending, but there's something like reckless spending as well. and people must make sure that they can afford to pay back their loans. And but yes, that was the whole idea of the national credit.
In the run-up to the financial crisis, we saw intelligent, educated people who should have known better take on far too much credit. How can you blame poor people who are in many cases uneducated, desperate for a better standard of life, from taking an opportunity that's given to them?
No, definitely you can't blame the poor people for this, and definitely that's why the National Credit Act is there, and that's why the amendments. No, it didn't work, but that's why we're seeing the amendments now, and affordability criteria is now implemented. And I think, yes, it might be too late, because it could have prevented a lot of people becoming over-indebted. But, you know, people are struggling, and I'm not saying that...
Who needs to be sitting in your chair right now being given hell for this mess?
Well, I would think certain credit providers, and as Ian said, you know, it's not necessarily the big four banks. It might be the smaller guys giving out loans. Now, it's difficult to put me on the spot giving out names, but it's the smaller credit providers giving out loans, and they know that if they are being taken on for a reckless credit, they can just write off those loans, because it's very small loans.
But that's the trouble with with the whole mess. Ian Wason, who would you like to see in the hot seat being bludgeoned for contributing to this mess?
Rather than focusing on who's to blame for the mess we're in now, I think maybe we should have a look at what happens now. What happens to these consumers now? What happens to the credit industry now? So in my opinion, you're going to have this double squeeze. So there's going to be pressure on the large banks, presumably from their institutional shareholders, who are going to say, okay, pull back on unsecured lending. We've been burnt with Africa Bank. We can see what's happened there. So I want you to reduce your exposure, tighten up even further on your affordability criteria. You're obviously going to have African Bank, which is maybe 30% of the unsecured lending market. They presumably, particularly if they have a chartered accountant in charge of it, more stricter on their lending criteria, and hence they will pull money out, start turning the taps off as well. And then when you look at the affordability tests that are going to come in, a great many of those smaller, maybe slightly more unscrupulous credit providers who weren't doing full affordability tests are now going to have to do that. And a lot of these credit providers are going to find it very, very difficult to do that within their current models. If you look at something like Wonga, for example, they run a sort of automated model based on their algorithms. They don't really have human interaction there. And now with the new affordability test, they've got to get salary slips and bank statements. They've got to ensure, the onus is on the credit provider to ensure that that consumer is employed, that is their income, and that those are their expenses. I just don't know whether they're going to be able to do it with these new affordability tests. You're going to get a squeeze from both ends. They're suddenly going to turn off the taps for credit. And then what happens to these 13 million people who are already in arrears on their debt?
Ian Wason, thank you so much. The Chief Executive of Debtbusters in Cape Town. Neil Roets, the Chief Executive of Debt Rescue in our Johannesburg studio. Two gentlemen involved in mopping up the mess that has been left behind the credit fest over the last 5 years. Thank you for watching. There'll be more tonight, tomorrow. Until then, good night and goodbye.